The following is for educational purposes only. Hey, thanks for checking out this video on how to use infinite banking with the all-in-one loan. Now, I've been wanting to make this for a long time, and this is meant to be a short introduction to give you a high-level overview. So I'm going to attempt to quickly cover what is the infinite banking concept, why and when you would want to use a HELOC with infinite banking, what an all-in-one loan is, and why an all-in-one loan is simply a better option than a HELOC. Now, I'm making this video because in recent months, I've been asked by many who are already understanding the infinite banking concept how the all-in-one loan works from CMG. Now, if you believe you already fully understand infinite banking and you just want to hear about how to use it with the all-in-one loan, you can fast forward ahead to approximately this time mark in the video. But first and quickly, for those of you who follow my channel regularly, you may be asking, what the heck is infinite banking? The infinite banking concept, sometimes called wealth creation account or private family banking, or simply BYOB, be your own bank, has been used for over 100 years by many of the wealthiest families in the world to grow and protect their wealth. For example, the Rothschilds and the Rockefellers are the most often cited major families to use this. It's even been acknowledged that Walt Disney used this strategy to fund and start Disney. Now, before I go any further, let me start by defining basic concepts of both. You have the infinite banking concept, which I may call IBC for short, and the all-in-one loan, which I may call AIO throughout this video. IBC is a way to put your money to work for you twice. The all-in-one, the AIO, is the best way for you to wipe out your mortgage debt and lower your mortgage interest expense. The basic overall objective of both is to grow your wealth in the safest way possible. And it's very important to understand that both IBC and AIO are powerful financial tools that can be used in a variety of ways that are unique to your personal circumstances and objectives. A traditional home mortgage is like a butter knife. It's made for one primary thing. But the all-in-one, similar to IBC, is like a Swiss Army knife. 33 tools with endless list of possible uses. In other words, there's no way for me to show you all the uses in this short video, but I do want to open your eyes to some of the possibilities. And at the end, my goal is for you to understand that you can likely use one or both of these tools and then reach out to either me or the person who shared this with you to further explore your unique scenario. Now, you may have heard me use Albert Einstein's famous quote before: compound interest is the eighth wonder of the world. Those who understand it, earn it, and those who don't understand it, pay it. To explain the power of compounding, you may have heard me ask, what happens if you double a penny every day for 30 days? In other words, if you start with a penny on day one, the next day you have 2 cents, then 4 cents, 8, 16, 32, and at the end of the first week, you have 64 cents. Think about your answer for a moment. If a penny doubling every day goes to 64 cents at the end of the first week, how much will you have at the end of 30 days? Now, most people will guess somewhere between $100 and $1,000. A few of the very suspicious ones will say, I'll bet it's something crazy like $100,000. Well, let me share my calculator on the screen as I do this because the answer may shock you. All right, so we have 64 cents at the end of week 1 times 2. That's day 8 times 2 is day 9 times 2, day 10, day 11, day 12, day 13, day 14. At the end of 2 weeks, you have $81.92. Let's keep going. Times 2, that's day 15, 16, 17, 18, 19, 20. By the end of 3 weeks, you have $10,485.76. All right, one more guess. What are we going to have at the end of 30 days? So that's day 22, 23, 24, 25, 26, 27, 28, 29, 30. We have $5.368 million at the end of 30 days. And if it was a 31-day month, you'd have over 10.7 million. That's the power of compounding in your favor. It's exponential growth. And if you look at exponential growth on a graph, it looks something like this. Remember, that penny doubling every day didn't sound like very much until about day 17 or 18. But allowing time to work in your favor compound growth becomes exponential growth. Okay, let me give you the basic idea behind the infinite banking concept. Most of us earn income from a job or a business. And where does that income go? It gets deposited into our checking account where it sits until we're ready to spend or invest it. When you do, it exits your checking account to pay the mortgage, pay the car, pay for groceries, clothing, your electric bill, your cell phone bill, etc. The money leaves your account and it's gone. And if it was earning any tiny amount of interest, any compounding growth that would have been in your favor is gone as well. The infinite banking concept adds one extra but very powerful step. Your money goes from your checking account into what is essentially a bank that you own. And then you pay the bills from your bank. So why the extra step? Your bank is the safest, most secure bank that you can imagine, and your deposits grow and compound at a very generous rate of return. Now, here's the important part. When you make your payments, you're actually making them with a loan to yourself from your bank. And that loan is made on very generous terms that you get to set. So why do that? Because 100% of the money that you put into your bank continues to compound and grow uninterrupted. In other words, you take advantage of that penny doubling principle while still being able to pay your bills. Now, before I show you an example of how this works, let me answer the question you're probably already wondering. What is the bank that I'm going to be able to own? It's a financial investment that you're going to use like a bank. Okay, so what type of investment is it? Again, let's answer a really important question. What would the ideal investment look like to you? If this is the first time you're seeing one of my videos, you should know that I spent over 15 years in wealth management and private banking. I worked for Bank of New York Mellon, BNY Mellon, which is best known for being the world's largest custodian bank, meaning they are the number one bank on the planet for major corporations, governments, and the world's wealthiest families. I've personally seen what their clients look for in an ideal investment because I can guarantee you'll want the same thing that the wealthiest people in the world do, right? Well, they would want a high and consistent rate of return. They'd want liquidity and an easy exit strategy. They'd want guarantees. They want safety. They want tax benefits or even tax-free. They want no market volatility. They want credit protection. They want it to be inflation proof. They want to be able to control the asset. They want it to be transferable. They want it to be easy to manage. They want low fees and no penalties. And they want it from a reputable company. And they want privacy. They don't want government bureaucracies prying into their lives. So is there a single investment that fits all this criteria? There is. What you're describing here is dividend paying whole life insurance. Now, not only do the uber wealthy use this investment, but they actually use strategies to borrow to finance it. A few decades ago, a man by the name of R. Nelson Nash wrote a book teaching this infinite banking concept titled Becoming Your Own Banker. In short, they use a specially designed type of life insurance strategy that maximizes your cash value right from the start and pays far less commission out to the insurance agent. In case you're wondering, why haven't I heard about this before? That's probably part of the reason why. Okay, let's get back to the point I was starting to make earlier on how to make this work for you. We said that instead of paying your bills directly from your checking account, the infinite banking concept adds that one extra but very powerful step. Today, your income gets deposited into your current checking account, sits there until you're ready to pay the mortgage or rent, to pay the car, to pay the credit cards, to pay for the groceries. And using IBC, your income will get deposited into your current checking account and then into your bank, which is the infinite bank policy. And when you pay your bills from your bank, why would you do that? So let's look at a typical example of how it looks to take your money from your checking account into your infinite bank policy and then paying your bills. As we go into 2025, the average price of a new car in the US is just over $48,000. Now, normally your choices would be pay cash. Maybe you're disciplined and you can set aside $1,000 a month towards your future car for the next 4 years. That's $48,000. You'll earn a little interest while you're saving, But then after 4 years, you'll pay cash and your $48,000 is now gone from your account. You bought the car you needed, but it's a depreciating asset from the moment you drive it off the lot. That money is gone forever, and that is no longer growing at an exponential compounding rate. And you continue saving $1,000 a month for the next 4 years for the next car. Your second option would be to take a loan or a lease and make monthly payments. And the lender or bank that gave you the loan or the lease makes a lot of money off you. But when you have an IBC account, you ask the dealer, what is the best rate and terms that I could qualify for, assuming I have perfect credit without having to pull my credit? In other words, you're going to let the finance guy or gal at the dealership do your homework for you. Let's say they come back and they say, we can give you 100% financing on this car for the full $48,000 at 3% for 5 years. Your monthly payment will be $862.50 a month. You say, thank you, I've decided to pay cash, and you borrow the money from your bank and you pay yourself back the $862.50 per month. That means you're the one that is getting paid back $51,749.83. You just made $3,749.32, about $750 a year for the first 5 years, plus the entire time your $48,000 was still sitting safely in your bank, compounding and growing safely, plus you were adding $750 per year to that balance, meaning your bank was growing even bigger, faster. Now, as was pointed out at the beginning, this video is for educational purposes only. I do not sell or help you or anyone else set up an infinite banking account. If you're interested in learning more, I can direct you to some people who are very good at helping you do that. Just give me a call or send me a text. Now, you may be wondering, how do I fund my infinite banking account? Remember what I said earlier, this is like a Swiss Army knife, and it can be used in a variety of ways. And people who use this fall across the entire spectrum. For example, you could have lots of money and no debt, or you could have no money and lots of debt. Maybe you want to be debt-free, including paying off your mortgage, or maybe you want to always have all of your money in motion working for you. So let's look at a couple of quick scenarios to help you start thinking about how you would use this. Maybe you don't have any savings and you have a lot of credit card debt. You can start off very small, like $50 to $100 a month small, taking the funds that you would use to pay off your credit cards and running them through your IBC account to pay them off one by one. Meanwhile, you're also building your bank, allowing that money that goes in to start having that exponential compounding growth effect, which in turn allows you to pay off your debts even faster. Maybe you have the funds sitting somewhere else that you can move into the IBC account, giving yourself greater benefits, safety, and asset protection. Or maybe like a lot of Americans, you unfortunately got stuck with an investment that has a guaranteed rate of return of 0%. Now, speaking to you as a friend, would it be safe for me to assume that you would never knowingly make an investment that has a guaranteed rate of return of 0%? Did you know that today over 85 million Americans are putting money into this zero return investment without even realizing it? Imagine an investment advisor coming up to you and saying, I'd like to show you an investment that's guaranteed a rate of return of 0%. It's an investment that can go down in value. You could lose some or all of your investment. And maybe the worst part is you have no liquidity. If you ever need to access your investment dollars, it could be very difficult, if not impossible, to get out. How much would you want to put into that investment? Well, that investment is more commonly called paying down your mortgage. Now, I'm not saying that that's an entirely bad thing, but most of us overpay on our mortgage, and it doesn't matter if it's at 8% or 3% or even lower. If you're taking a traditional home mortgage, odds are you're overpaying. That's right. You might have a 3% mortgage today and you're still overpaying. More on that in a moment. But first, let's talk about your home equity. The money that is literally sitting in the walls of your house earning 0%. Your equity in your home can go down, causing you to lose some or possibly all of the cash that you put in. And if something unexpected happens down the road or the market changes, you might not be able to access that cash. And this is the reason why a lot of people who understand infinite banking want to know about using a HELOC to access some of that equity, both for investment opportunities as well as for unforeseen needs and emergencies. And if you understand how to best use that for your scenario, that's a great option. However, if you're going to pursue that path, there's an option that's even better. It's called the All-in-One Loan from CMG, and it's the only loan of its kind in America. Now, similar mortgages have been around for decades in other countries like Australia, New Zealand, parts of Canada, Western Europe, and even India. We even used to have them here in the US prior to 1913 and the creation of the Federal Reserve. And that's an interesting story for another video. In these other countries, they are generally referred to as offset mortgages or sweep accounts. So we already looked at how you could use the infinite banking when you're buying a car. So now let's ramp it up a notch and add a zero. Instead of a $50,000 car, let's say it's a $500,000 home. Maybe you bought a home that you managed to pay down rapidly as it was appreciating in value. You were the person who wanted to knock out the mortgage first, and then you intended to start investing once that goal was accomplished. Nothing wrong with that. Nothing wrong with wanting to do that. However, the challenge is that you effectively managed to invest $500,000 at a guaranteed rate of return of 0% interest, and you have no savings, not even an emergency fund in this scenario. So, using a traditional home equity line of credit, a HELOC, you could borrow at prime, and maybe you could invest it in flipping houses, which Motley Fool website says the average return investment on house flipping in the second quarter of 2024 was 30.4%. And you may recall the US economy wasn't doing too good at that time. Personal income was trending down, personal expenditures were trending higher, yet the average home flipper was still making 30.4% return on their investment. Now, maybe you're not into construction and you have no interest in house flipping, but I guarantee there are a lot of great folks out there who do want to flip houses but need access to cash. And this is where you can become their bank. That 30% ROI a flipper can make if they use their own cash drops to zero if they don't have access to the cash that they need. So rather than earning nothing, do you think they would be willing to pay you 12 or 15%, a third to even half of their profits, so that they could make the rest of that 30% or more return by using you as their bank? So now you're borrowing at prime, currently at 7.75% as of this recording, and lending at 12 to 15%, meaning that you're making a spread of 4 to 7% over the cost of your HELOC. But what if you use the infinite banking concept? Now, instead of paying the bank 7.75% on your equity line, you start paying that back to the bank of you. As we said in the prior example with the car, now that $500,000 keeps growing and compounding year after year while you're still making a spread on that money on top of it. In other words, you're making your money work for you twice. Now, I'm going to show you how to make it even better. Maybe you've been at it for several years and maybe you've built up your IBC account to the point where you have $500,000 laying around waiting to be invested. But maybe you don't, or you're just starting out, but you have equity that has grown in your house, either through additional principal reduction payments or through appreciation. As we said, you could take out a HELOC or any other form of cash out refinance. You could then use that to fund your IBC account, which you would then use to invest. Then you would use a portion of that income stream to pay back your HELOC or the cash out refinance mortgage. That may sound complex, but here's an illustration to show you just how uncomplicated it is. Let's say you have equity of $300,000 in your home, currently earning zero, and you want to invest it into a property that you can Airbnb for $4,000 a month on average. But let's go conservative and say you rent it out long-term on a lease instead for only $3,000 a month. Your rental income is $3,000, your mortgage payment is $1,800, and your taxes and insurance are $500. So you bring in $3,000 and you pay out $2,300 for a $700 a month profit. That's $8,400 a year. After 10 years, that's $84,000 that you've made. Now, Let's look at doing the same thing, but adding the additional step of IBC, where you take out the same $300,000, but deposit it first into your IBC policy, into your bank. Now you borrow the money from yourself at 4%, while your money continues to compound and grow at 6%. You still have the same mortgage payment, $1,800 plus the $500 tax and insurance, and you still have the same $3,000 a month rent and $700 a month or $8,400 per year in profit. After 10 years, you've made the same $84,000 in rental income. However, your IBC account with that $300,000 in it the entire time has been compounding at a positive spread of just 2%. You borrowed at 4 while still earning 6. That account has grown by over $66,000. Combined with the $84,000 in rent, you're now up a total of $150,000. So stop and think about that for a moment before we go any further. Option A is do nothing. Let's say your home is worth $400,000 and you own it free and clear. Conservatively, let's assume it appreciates at only 3% annually. So after 10 years, it's worth $540,000. So your net worth is up $140,000. With option B, you pulled out $300,000 in equity, you paid cash for an investment property, you made $84,000 in rental income, plus your $140,000 in appreciation. Plus, let's not forget about the $105,000 using the same appreciation on the investment property. So your net worth is up by $329,000. Now, option C, you do the same thing as option B, only you add in the extra $66,000 in compound growth in your IBC account. So your net worth is up by $395,000. And now we're going to talk about option D, adding in the all-in-one loan. Option D gives you the same $395,000 as option C. However, in option C, after 10 years, you still have an outstanding mortgage balance of over $250,000. But with the all-in-one loan in this example, your mortgage has a zero balance, meaning your net worth is up by an additional $250,000 for a total net worth increase of $645,000. So it's a pretty simple question. Would you rather your net worth be up by $140,000, $329,000, $395,000, or $645,000? It's a simple question and a really easy answer. Now here's where it gets even better. What happens over the next 10 years? Well, with options A, B, and C, it's basically the same progression, but your values are compounding from a higher starting point. So you end up with the following net worth increases in total from today. Option A is up $328,000. Option B is up $574,000. Option C is up $721,000. And option D is up $1.354 million. In other words, you're up over $1 million in net worth versus just sitting on your $400,000 home that you own free and clear today. So how is option D so much more? Simple. That $300,000 loan that you paid off in the first 10 years using the all-in-one loan, you can redraw that $300,000 out again without needing to requalify, and you can buy a second investment property, adding $300,000 into your IBC account again. Now, maybe you don't want to be a landlord and buy additional properties. That's okay, because with infinite banking, you are the bank. You can lend to yourself, like this example we just looked at, or your bank can lend to someone else who wants to take on the work and risk of any of the investments. Like any bank out there today, you can determine who to lend to based on how safe their investments are. And there are literally thousands of people out there doing this every day. You may even be one of them. But the question I know that you're definitely asking yourself right now, if this is the first time you're hearing about the all-in-one loan from CMG, is what the heck is this thing and how does it work? Again, a traditional mortgage or traditional HELOC are both like butter knives. The all-in-one loan is like a Swiss Army knife. Not only can it do more, but it can allow you to have the lowest possible interest expense. Let me quickly explain. You're probably well aware that your traditional closed-end mortgage, that you have a fixed predetermined payment that will not change unless you refinance or recast your mortgage. It's called an amortization schedule. And for the past 85 plus years in America, we've come to accept that something that just is what it is and that we have no control over it. However, as I mentioned earlier, prior to 1913, when the Federal Reserve was created, mortgages worked in a completely different way. Most Americans are unaware of this type of loan, but it has existed for decades in other countries, from much of Western Europe to India, Australia, New Zealand, and even parts of Canada. And in the US, they even still exist in the commercial banking world. And they're referred to as universal accounts, sweep accounts, or offset mortgages. And we call it the all-in-one loan. CMG engineered this product in the early 2000s after our CEO learned about it while speaking at a banking conference in Australia in 2001. We launched it in 2005, and I've personally have had clients in it since 2006. And they will all tell you the same thing. It is truly the greatest mortgage product ever. Why? Well, let's start by looking at a traditional 30-year fixed mortgage because over 92% of all mortgages in the US are a fixed rate. I mentioned the amortization schedule, and when you closed on your most recent mortgage, I can almost guarantee that there were a few pages in there that they showed you this. And your attorney or the closing agent likely brushed past this quickly, and they may have said something like, and this is what you'll end up paying over 30 years if you keep this loan. But don't worry, nobody ever keeps a mortgage for 30 years. And that last part is true. The life of the average mortgage is still less than 8 years. And this is exactly the reason why you need to worry. If you're not fully aware, you're still likely somewhat aware that on a traditional mortgage, you pay mostly interest up front. But odds are you've never taken much of a look at exactly how much interest you're paying up front. Now, understand, traditional mortgages are not fully evil. They do have a place. They are often the only pathway for ownership for many Americans, especially first-time home buyers. But my mission has always been to help people find the best way to strategically handle their mortgage financing. And in 26 years of doing this, I can say without hesitation that the all-in-one loan is the best financial tool for handling your mortgage debt. Now, you may want to get a bucket because this next portion is likely going to turn your stomach. But it's crucial that you understand this, and it's not complicated at all. It just simply normally gets ignored. When you look at it on a graph, it looks like this. This is a 30-year graph with each bar representing 1 year of total payments. And as you can see, the total payments are the same each year. What changes is the makeup of those payments. The upper portion is the principal paid, and the lower portion is the interest paid. And with a typical mortgage at today's rates, you're going to pay more interest than principal, generally for 18 to 21 years. And remember, we just said the average mortgage lifespan in the US is only 8 years. That's because people either move or refinance. Either way, that resets the clock and people go back to paying more interest all over again. So just how much more interest? Well, let me share my screen with you here. Okay, so let's look at what it would be on a $300,000 loan amount at 6% for 30 years. And in this example, I'm starting the first payment, assuming at October of 24. The principal and interest payment on that would be $17.98 and 65 cents. So you see that first month payment in October of 24, that interest is $1,500. The principal is $299 for the total of $1798.65. And your balance has gone down by that $299. So $299,701. So that's your total payments, your total principal, total interest. And that interest as a percentage of your total payment is 83.38%. And as you can see, that doesn't get much better as time goes by. In fact, we go down at the end of just the first 5 years, you're still paying over 80% of your payment every month going towards interest rather than going towards principal. If I go to the end of 10 years, that would be September of 2034. Your ending balance starting out at $300,000 after 10 years is now down to $251,000. You've paid a total of $215,000 in payments at that $1798. You've paid total principal of $48,944. You've paid total interest of $166,897. That means after 10 years, still 77.32% of your payment is going towards interest expense. And that's why I say this is extremely dangerous. But you're saying, Mike, my interest rate is 6%. How can it be that much? Remember, that's 6% amortized over an entire 30 years. But when you look at what your total paying is out of pocket, if I take that all the way down to the end of 30 years, you will have paid back your $300,000 in principal. You would have made total payments of $647,000, meaning you paid $347,519 in interest on top of the $300,000 principal you paid back. In other words, you've paid for your house more than twice. 53.67% of your payments, if you stayed in it for the full 30 years, have gone towards interest. And it doesn't get much better at 3%. If we take the same thing at 3% for 30 years, your payment drops to $1,264. So you are paying more principal, less interest as a whole of that payment, but it's still 59.29%. If I go down for the first 10 years, again, we said most people will refinance or move within 8, but at the end of 10 years, you're still paying 52.6% of your total payment is going towards interest rather than principal. And so that's why I say, even with that 3% rate, you're really overpaying. So as you're looking at this, you're probably thinking to yourself, there's got to be a better way. And there is. Today is the day you get to find out there really is a better way. So how does the all-in-one loan work? When you think about it, a mortgage is simply just an algebra equation. On your mortgage calculator, you enter just 3 simple variables: interest rate, principal, and time. And we solve for X, which is the monthly payment. So we start with 360 months at 6% on $300,000 in principal, and we solve for payment, which equals $1,798.65 per month. And when we multiply that by 360 months, that would be that $647,514. That's right. You end up paying for your house more than twice. And that's the best case scenario if you stay in the same home for 30 years. And on a traditional mortgage, that's just the way it is. That's the way the equation works. But who says that a lender can't change the equation? Going back to that graph, we start out over here on the left side and we pay interest first. But what if we could start over here on the right side and pay principal first? Wouldn't that be nice? Well, that's what the all-in-one is designed to let you do. Simply put, the all-in-one combines your mortgage with your personal banking. What happens when you get paid today? Where does that money go? It goes into your checking account, and it sits there until you need to pay bills or other living expenses. If you have anything left over, you can invest it or put it against your mortgage as an extra principal reduction payment. But remember earlier when I said traditional mortgages are closed-end mortgages, meaning once that money goes in, you can't get it back out. Not only is that very limiting, but it can also be very risky and costly. What happens if you need that money for an opportunity or for an emergency? It can be very expensive to access, assuming you can even access it at all. But the all-in-one loan is an open-end mortgage. This means that you can access your funds at any time you need them. That's because it is both a mortgage and a checking account that have been effectively bolted together. So let's go back to that example of a $300,000 mortgage at 6%, and let's say you have $10,000 in monthly household income. In your current world, that $10,000 goes into your checking account and earns little to nothing while you wait to use it. Meanwhile, the bank is putting that deposit to work every night, making money with your money. The all-in-one says, what if we let you use your money? So the money that gets deposited into your account today offsets your mortgage balance. So when that $10,000 payroll deposit comes in and your mortgage is automatically reduced from $300,000 down to $290,000, meaning instead of paying interest on $300,000, you're now only paying it on the $290,000. And then meanwhile, just like your normal checking account, you have that $10,000 available to access anytime you'd like. It's just like your current fully functioning checking account with Visa debit ATM cards, checks, online banking, auto deposit, automatic bill pay, ACH transfers, both in and out, wire transfers available, everything you would normally have. Now it's simple interest, and that means you only pay interest on the outstanding principal balance. So let's say that after your paycheck comes in for that 10,000, it stays at 290,000 for the first 5 days after that check comes in. Then you go to the grocery store, you spend $200. Now the balance goes up to $290,200. The next day, you spend $5 at Starbucks. Your balance goes back up to $290,205. The next day, someone who owes you money gives you a check for $300. You take a picture with your phone, and that balance immediately goes back down. And now you're only paying interest on $289,905. Whereas on your traditional 30-year fixed mortgage, you would be paying interest on the entire $300,000 for that first month. Now, this continues as you pay your bills throughout the month. And of course, it helps if you try to schedule the majority of your payments towards the end of the month, keeping your balance as low as possible for as long as possible. And here's an interesting side note. Because you can see your mortgage balance at any time on your cell phone, we find that most of our customers now become far more conscientious of their spending habits. Hey, if I order that item on Amazon, that's going to raise my mortgage balance. Do I really need that item? So what about your mortgage payment? This is the part where it's okay to get a little excited. You don't have a predetermined mortgage payment. Let me say that again. You don't have a predetermined mortgage payment that's due on a certain day every month. When your deposits come in, they get applied 100% to principal reduction first. Keeping your principal balance lower every night reduces your total interest expense. The rest of your normal monthly spending habits stay the same. So let's say that out of that $10,000 a month that comes in, $8,500 goes back out every month for bills and living expenses. Now, on that $300,000 traditional mortgage, we said you would have normally been sending in a payment of $1,798.65, of which 83.38% would have gone towards interest and only 16.62% would have gone towards principal reduction. That $1,798.65 is part of that $8,500 in normal monthly expenses. So with the all-in-one, 100% of the payment was contained within that initial deposit, meaning 100% of it was applied towards reducing your principal first, along with the rest of your deposit. So the rest of your spending stays the same, and then at the end of the month, CMG calculates the outstanding lower mortgage balance each night and what the simple interest payment would be for each night. It's totaled up at the end of the month, and then that interest payment gets put back on top of your balance on the 21st of the following month. In other words, you even get to have that interest payment working for you, offsetting your mortgage balance even further for the next 20 days. Think about this. You probably have more income deposited into your checking account every 3 to 5 years than the entire balance of your mortgage. Imagine the compounding effect that this has in your favor. But rather than imagine it, let's actually look at it. All right, so this is the interactive comparison simulator for the all-in-one on my website. And what I recommend that you do is reach out to me via phone or text or email. Let me know that you want to set an appointment, and we'll go through this together. And then you can take these numbers and go back and play with them on your own once we make sure that we have it set up properly for you. But in this scenario, we're going to use the numbers that we've been using: a purchase of a primary residence. We're doing a new all-in-one loan, an AIO versus a new traditional loan. It is a 1-month adjustable rate, and as you'll see in a moment, the rate doesn't matter. The estimated home value we're using is $375,000. The loan balance is $300,000. We said a 30-year fixed is the comparison loan at 6%. Now we said that comparison payment would be $1,798.65. No additional extra monthly payments, no second mortgage. Then we come over here to the deposits. We said you had $10,000 a month coming in. That's after your taxes and deductions. We said that would come in monthly. And then we're going to assume that you save 3 to 6 months of that monthly income in an emergency reserve account that normally sits in a liquid checking or savings account where you can access that for emergency. So that 3 months would be $30,000. And instead of letting the bank use that money, you can use that now to offset your mortgage balance. And that checking account typically gets set up so that you can start depositing money by month 2. So we have that $10,000 coming in every month. That's $120,000 a year and $30,000 of a one-time deposit. We come over to the spending page. We said of that $10,000 in deposits, $8,500 of that is going out in expenses. So we have the $1,798.65. That would be your comparison loan payment. Again, the all-in-one is about not changing your current spending habits. Estimated taxes and insurance on that property would be $511.50. You'll want to plug your exact numbers in there when you go through your scenario because this will use a national average. And then the balance of the remainder is $61.89 for your average monthly expenses. So again, this is $8,500 and you're saving $1,500 or 15% of that $10,000 is left over every month sitting in the account. We calculate the results. And on the all-in-one loan, you would pay off in 10.1 years versus the comparison loan, paying it off in 30 years. Both loans, you're paying off the $300,000 principal balance. But again, on that 30-year fixed at 6%, we said you'd pay $347,000 in total interest expense for a total of $647,000, whereas paying off the $300,000 and only $123,000 in total interest, paying it off in 121 months, you have a total of $423,000 versus that $647,000, so a savings of $223,000. Now, really important, I said back when we were on that setup page that this is a 1-month adjustable rate. So let's just look at a worst case scenario under the rates and assumptions. We go into this page and assuming that we stay at the initial rate, which is 7.849% currently as of this recording. Remember earlier in this video when I said that if we can lower principal and if we can shorten time, rate starts to no longer matter. So we're comparing this to a 6% 30-year fixed, and we were using a 7.849% rate currently on the all-in-one. That can go up, it can adjust monthly, and it can go to a max rate of 6% above your start rate. So let's just jump right ahead there and let's assume that in month 2, it goes to the max rate, it stays there, and it never comes down. That's your doomsday worst case scenario of what could happen. And if we return to those results, you still pay it off in 13.3 years and you still save over $100,000. That is your worst case scenario. Now you can go in and you can play around with this and you can say, well, what happens if it goes down to the historic average? Or what happens if it goes down to the floor rate? Or you can even enter rates manually for what you want it to be on any given month. But I prefer just to say, what if we just remain at the initial rate? That's pretty conservative because rates are expected to go lower. And again, if we do that, you're paying off in 10.1 years, saving $223,000. If you look at the pay down summary, and this is pretty interesting, when you look at the all-in-one compared to the comparison loan, again, that comparison loan, the APR we said was 6%, but the comparison effective loan APR is 2.446% on the all-in-one loan. And what that means is that on that 30-year fixed, you would need a rate of 2.446 in order to just be equal to the all-in-one, and that's assuming that rates never come down. If rates go down, that comparison effective loan APR would be even lower. So as you can clearly see, the all-in-one loan is a powerful tool to lower your home mortgage interest expense. Combined with infinite banking concept, you have amazing flexibility to grow and protect your wealth in a way that you determine is best for you. Everything from becoming 100% debt-free to keeping all of your money working for you while maintaining the lowest interest expense possible. Now, while there are many other benefits to the all-in-one, let me show you one more that I think you'll find pretty incredible. So remember something that I said earlier in this video. One of the very powerful features of the all-in-one loan is that it's an open-end mortgage rather than a traditional mortgage, which is closed-end. So what does that mean? That means when you pay money into a closed-end mortgage, that money is stuck in there. You can never get it back out no matter what. Same thing with the traditional HELOC. At some point, that HELOC has a limited draw period and you can't get the money back out. On the all-in-one loan, you have access to your funds for up to 30 years. Again, we said that's a $300,000 credit limit, and you have that credit limit available for the first 10 years. So regardless of what you've paid down in principal, you can always pull back out up to that $300,000 limit for the first 10 years. Starting in year 11, we're going to start reducing that available amount. So 20 years, 240 months, we're going to reduce it by 1/240th every month for the next 20 years. So meaning by the end of year 20, you're down to 150,000 available. By the year 25, you're down to 75,000 available. And by the end of year 30, you're down to a zero balance because we don't want you to have a balloon payment at the end of all this. So now let's take a look at what this might look like for a typical client. Let's say it was a $500,000 line that they were paying down the principal on. They saw how well that was working, but then they had some college tuition costs come up. So they pulled those funds back out and returned to paying it back down again rapidly. Maybe their income slowed here at this point, so it paid a little bit slower. They wanted to use more cash for other things. But at some point it got paid off. And in this example, they decided to buy a rental property. They paid that off. Then they had some medical expenses come up. They paid those off. So I've seen clients over the past 20 years with this loan that have used it where they've paid off their mortgage balance in 5 to 7 years, and then they pull it back out because they've seen how great it works and they buy an investment property. And now you've got that additional income coming in from the investment property, and you buy a second investment property and it pays off even faster. And people keep rolling that over and over again, growing their wealth and their net worth. Well, I know I've hit you with a lot of information. I appreciate you hanging out here till the end. And if you found this information valuable, I'm going to ask you that tiny, tiny favor. Just like every other channel out there, please hit the subscribe button. It's going to help me grow this channel, which is going to allow me more time to invest in future videos. And if you really liked it, please give it a thumbs up and maybe even leave a comment. And if you absolutely love it, then you should share it with a friend or two. Again, I'd welcome the opportunity to have a no cost, no obligation mortgage coaching call with you. Just send a text or email or simply visit my website at musiccitymortgagecoach.com. Thanks for watching.